Atocha Global Analytics. Please like and subscribe.
Hi, KT here with Atocha Global Analytics. Want to remind you that Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. So we have created a number of segments on our channel that cover the misleading information about the economy and finance trends. Namely, everything is fine and questionable truth of the day. Both those segments, of course, take articles or statements by policymakers and shows you where they are either misstating something or not telling you the full truth. We also have Forecast Fridays, where we focus on unconventional or noteworthy metrics that show us where the economy will be in the very near future. And we have Policy Matters, because policies matter, because so many of the policies that shape our economic and financial reality are misguided, misunderstood, or misapplied. So we like to do some informational videos, case studies, explore the data, and do deep analytics where the real numbers are shown. And it's all to empower you, the street-level real estate investor, to succeed. An informational video that was done a while back addressed the 3 modes of persuasion, which was something that was explored in depth during a writing course while getting my master's at Harvard, and it truly applies here. Ethos, pathos, and logos are the 3 modes of persuasion, and we want our ethos to be focused about logos and not about pathos. In this video, we're exploring the Laffer Curve. The Laffer Curve has been controversial since it was first published in the 1970s, but few people outside of academia seem to really know what it is. So here you go. To demonstrate the logic behind the Laffer Curve, I've set up a basic graph that shows the tax rate on the horizontal axis and tax revenue on the vertical axis. So the tax rate is from 0% to 100%, and the tax revenue ranges from 0 to the maximum possible revenue, whatever that might be. Now that the graph is prepared, let's add the curve itself. Here's a very benign looking parabolic curve. The parabolic curve may not be exactly the right shape, but it's just a crude model. It's a demonstration of the theory. As you can see, if you look at 0, or the starting point, a 0% tax rate nets you 0 in tax revenue. That's obvious and logical. There's nothing to refute there. As the tax rate increases, so does the tax revenue. At some point, maximum tax revenue is reached. And then, as the tax rate increases, the argument is that revenues begin to fall. The argument is that when taxation becomes too pervasive, the people stop producing, and so revenue falls because production is falling. Much like the Soviet Union and North Korea, which operated under very draconian communist principles, productivity was quite low, as there was no incentive for people to produce when they didn't get to keep what they were producing. Essentially, this is akin to slavery or indentured servitude, in that the individual producer is not incentivized to produce because they don't actually benefit. Much of the controversy around the Laffer Curve and accusations that it has been disproven is or are unfounded. The logic of the Laffer Curve may be undeniable, but the semantics here are huge. Where the argument lies is the shape of the curve, or where current taxation actually puts us on the curve. The creator of the Laffer Curve, ironically named Art Laffer, has regularly argued that the U.S. is overtaxing our economy and that lowering taxes will increase revenue once production increases. The problem is that there's always a delayed effect for that production to actually impact the economy. The counterpoint is that lowering taxes doesn't make an impact or doesn't benefit the demographic or economic strata that the opponent wants to see benefit. Those are political arguments, and I really want to ignore them here because it's not really directly tied to the Laffer Curve. It's tied to much broader issues than just the curve. So what I want to focus on is, in finishing this up, is the shape of the curve. First, I'm going to show the shape that aligns with Art Laffer's assertion. If you look at the blue line, this generally demonstrates what Art Laffer says is the optimal tax rate. That a very broad-based and lower tax rate creates the most revenue because it grows the economy the fastest. Conversely, when I add the red curve, you can see what his intellectually flexible opponents assert. Intellectually Inflexible opponents claim there is no decline in revenue for higher taxes. Of course, many of these intellectually inflexible opponents also claim that increased prices in oil do not adversely impact the economy, and data over the course of decades has clearly shown that the increase in oil prices, our primary source of energy, has coincided with every major recession since World War II. It is as near to irrefutable as economic data often gets that the cost of energy, whether it is up or down, either benefits or harms the economy. Similarly, taxation has a similar impact, but only taxpayers are directly impacted by taxation. And of course, anyone who's ever owned a business understands that taxes are an expense just like anything else that a business deals with. Therefore, a business must earn enough to cover whatever tax costs they have, just like any household budget must cover all its expenses. So it is my opinion, like so many others, that the general logic of the Laffer Curve is undeniable, but the semantics of the curve and the source of tax revenue is where the real argument lies. The old adage about death and taxes, here the Laffer Curve is really just a method of understanding how taxation logically works and for managing the pain. Thank you for listening. Please like and subscribe, ring that bell, give us a thumbs up, and see you next time.
Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.